Want to save hundreds of thousands of dollars in mortgage interest payments by paying your home off in a third of the amount of time by utilizing the infinite banking concept through infinite family banking? Or is there a better way to provide your family with more liquidity and added benefits by not paying your house off early? Which is better than you? Stay tuned in this video and find out. For the best information on the infinite banking concept, becoming your own bank, savings, and the best tax-free retirement programs, make sure you like my video, subscribe, and don't forget to hit the bell so that way you're reminded whenever I post new videos every week. So let's get started. So what are the advantages and disadvantages of paying off your home early using your own banking system? Now remember, we're not talking about paying off your home if you do not have your own banking policy. So would you prefer to pay off your mortgage early right now or not? What are your reasons? Pause the video right now and post in the comments below if you currently are in favor of paying your mortgage off early or not, and why. You're going to see multiple additional benefits no matter what your opinion is today on why you also need to integrate the benefits of infinite family banking. Here you're going to find out that you get the best of both worlds. At the end of this video, let me know if they changed your current opinion or if it just reinforced the thoughts that you had currently with the added advantages of infinite family banking. If you're unfamiliar with the benefits of infinite family banking, also known as the infinite banking concept or family banking, click the link in the description below. We have a webinar that goes through all the details on why you need an infinite family banking program in addition to what you see here. The consultation, free debt report, and planning session are all free with no obligation. A lot of variables will make a difference on how impactful that may be positively or negatively for you. Could be when you plan to retire. It could be your age when you retire. It could be your age or your spouse's age today. What are possibilities that your situation may change in the future? How much do you owe on your home and how long do you have at your current mortgage without refinancing to get to your final payoff date? Are you going to stay in your home forever? Is that your retirement home? Is it a possibility that if something happened to your health, or if one of you passed away, that you continue to stay in the home? So let's go over some of the advantages of paying your mortgage off early versus keeping that mortgage balance and using your funds for other things. So when we talk about an example of a family or a couple sitting down and talking with me about how they can get out of debt, pay off all of their vehicles, as well as pay off their mortgage early, and we have a written game plan, and let's say that that game plan gets them 100% out of debt in 7 years, including their mortgage. Well, generally speaking, I've seen that in less than 2 years or maybe 3 years, all of their debt's paid off, and that's included if they have $30, $40, $50, $60,000 or more in vehicle payments. Because if they have 2 new cars, as well as credit cards or student loans, it's very possible that they have that much extra debt other than their mortgage payment. Now, if they had everything paid off except for their mortgage, and John and Mary, let's say, are sitting there, and they've got $200,000 sitting in their banking policy, and they have a $200,000 balance on their home, and all of their debt is free and clear, the question I would ask them is, do you feel like you have debt? Well, are they in debt? If your assets that are liquid, meaning you could write a check that's not like money that's wrapped up in real estate that you have to sell, not like money that's wrapped up in precious metals or anything in the stock market that might go up and they might go down, but liquid cash that you can actually pull out at any time in a moment's notice. Are you really in debt? Do you still have that peace of mind that if the market changes and real estate prices drop and you have a desire to sell, or maybe real prices go up and you want to sell. Some people, they just like the idea that they're debt-free and they have no mortgage payment. If that's something that gives your spouse and yourself the peace of mind of not having a mortgage payment, and you're not really worried about the value of the home when you sell it, you're not really worried about how soon you can sell it because you have other assets or other retirement income that you don't see as it being a risk to your lifestyle and be able to afford to live, then that may not be a big deal to you. Is there a benefit to you or your spouse to have that hanging over your head? A lot of people, it's not, and they have more peace of mind just having a debt-free home and not having that hang over their head. If that is what it can buy you, then does it really make a difference if you're making a few extra bucks by keeping it in something? Let's look at how the change in property values either going up, going down, and inflation going up or going down can affect you. Well, most of us would like to have our property values stay the same, or if anything, go a little bit lower while we're paying taxes on the property. But before we get ready to sell the property is when we want the value to be the highest. Do most people want to pay increasing property taxes every year for 30 years before they finally sell the property? Well, that's something that we as homeowners aren't really in control of. So let's think about this. If you have a concern that inflation is going to go way up and you intend to live in your home for the rest of your life, does it make sense to have your money in cash? Well, some people, or most people, would contend that it would be better to have that in real estate rather than in cash. Now, what they mean by that is if your money is in real estate, generally speaking and historically, the value of property has gone up to meet or exceed the rate of inflation. In many places in the United States, when property values went down and the market was flooded with homes in 2008, a lot of people were investing in property because prices were low, because they had liquid capital. They had the funds to make an investment when they saw an opportunity. So people that didn't pay their own mortgage off, but had additional cash, were able to make investments to either flip them or rent them for long term or just until they found a great buyer. So in many areas, there were beautiful waterfront properties in smaller communities that historically were very family oriented. When the mortgage crisis hit, so many of those homes went up for sale, and a lot of those properties are now rental communities. So you have a lot of people that had a desire to retire and live in maybe an area or a community that they grew up in, that when they started being lower or moderate rental homes, it didn't give them maybe the neighborhood that they really wanted to live in. And some people decided it was better to sell. Well, now because of the change in that market, because of all the rental properties that they couldn't have foreseen, they're not really getting the return on selling that home today that they really hoped that they would get. So even though generally speaking, a lot of people say real estate, you're always going to be able to make your money back, that's not always the case. In the last several years, I've sat down with literally hundreds and hundreds of families who said, Mike, I have no problem at all of whenever we want to sell this because the house right down the street sold for this price and it was only in the market for 3 days. Well, that's at today's rates. That's at today's market. And they themselves even bragged that when they got their home, they got it at such a great value because it was after the mortgage crisis. Now, I'm not saying or contending that there's going to be another mortgage crisis, but we all know that real estate prices go up, they go down, the market fluctuates and adjusts itself. Many people like the idea that they're more of an aggressive, they're more of a risk taker, and they feel that they can make a better return putting that money in the stock market than what they would do if they put it to pay their mortgage off. Well, remember that the stock market, for example, if you're putting it into a 401k retirement program, yes, you're getting the tax advantages today, but you got to pay those taxes in the future. Well, what are taxes going to be from now until that time comes? Do you think that they're going to go down? Do you think they're going to stay the same? Or do you think that they might go up? If you think that taxes are going to go up, you're getting the tax deductions today, but paying them tomorrow. So when you utilize infinite family banking or the concepts of infinite banking to create a high cash value life insurance policy whose purpose is to store your money until you're ready to use it. While it's being stored, you never can lose a dime. Your funds grow at a guaranteed rate of interest that's compounded, and all of that money is tax-free. So when we use that as a vehicle to pay our mortgage off early, we're able to put the money into the policy so that way we have liquid funds in case emergencies come up. If you're a property owner, if you own a home, you know that there's going to be other emergencies, expenses, maintenance, whether it's taxes, insurance that's regularly come up, but things that are unexpected or unplanned, like if you had a storm and you had a $1,000 deductible that you had to pay. That's money that's going to come right out of your pocket. Or if you had other things like the roof was leaking that wasn't covered by insurance, you have those emergency fund that's in your policy. If you weren't utilizing the strategies of infinite banking and you're simply just making extra mortgage payments or throwing that extra money that you may have through investments or other income, like if you had somebody that had a bonus through your career, through your job, or if you're a business owner, you may have fluctuations in your income. If you're an entrepreneur, we know that we have to make investments into our business or your practice, and that's something that isn't always planned. It's things that come up along the way. So by not paying your mortgage off early, by paying extra payments, and by putting it into your banking policy, that gives you freedom, gives you flexibility to use that money for whatever you want it to. Because let's face it, you can't eat your drywall. If you put a big chunk of money, say $80,000 or $90,000 into your mortgage to pay that off early of extra equity, some people might argue, hey, that money's still there. Well, how can you use it? The purpose for money is to be spent. But if you can't get your hands on it, don't assume that you can always go out and get a home equity loan. Those aren't always available if your credit changes or if something happens to your income. If maybe you've been working at a career for a number of years and have great credit, and God forbid you get a divorce, or there's a medical emergency, or a death in the family that causes an interruption in your income or an interruption in your expenses, and you have all of your money wrapped up in real estate, how are you going to get that money out? Some people may argue that having a home equity line of credit is an excellent way to utilize that asset. If your situation changes and you may not think that you're going to, but maybe you have to. Maybe you dreamed of living in this nice Victorian 2-story home, for example, with you and your spouse, and somewhere along the way there's a car accident and you or your spouse can no longer use the stairs. Well, yeah, you can invest a lot of money in remodeling your home or moving to a downstairs bedroom. But again, don't you think it would be better suited if you had that money that you could always write a check for that came out of your policy rather than coming out of a home equity loan? And remember, if you're utilizing a home equity loan, you are paying interest to somebody else. Whenever you send money away from your family or away from your business to finance somebody else's bank rather than your own banking policy, that's money that you will never, ever see again. Once that money is gone, that money is gone. When you put money utilizing your own banking policy and your own banking system, that's money that's always there when you need it, if you need it, or however you want to utilize it in the future, and it grows. So let's look at another advantage of paying your mortgage off early. There's zero risk to paying a mortgage off early. What do I mean by that? Well, if you look at how many years or how many months you have left in your mortgage, and you know what your interest rate is, obviously, then you're going to be able to calculate exactly what that return is for paying the mortgage off early. Now, if you pay it off early and you save, say, another $200,000 in interest, and you're able to save $1,000 in your monthly mortgage payment, that's $1,000 extra that you're going to be able to have liquid cash every month, since you don't have that debt, that you could put it to investments. You can put it into retirement. It also gives you the freedom and peace of mind to make more aggressive investments or riskier investments. Those might not always be the same thing, but if you and your spouse don't agree on what an investment is good or bad, or you're unsure of when the return would come, maybe you're invested or your interest is investing in real estate property, and there's a nice chunk of piece of land that is being turned into a subdivision. You decide that you want to start purchasing some parcels because you see how quickly that property is going, and you don't have that much to pay as far as an expense, since there's no property built on it now. No, the expense meaning you only have taxes and insurance. See that the value is going up, but you're not sure when that value is going to go up. Same with condominiums. Condominiums or condos might be a great investment for some people if they speculate that the prices are going to go up. The downside of investing in condominiums, for example, is we don't know if the market goes down and becomes soft and everybody starts selling them. Are you going to be able to liquidate your assets and get your money out when you need it? Because everyone else in the market is trying to get rid of theirs. Some people could argue that they could make an investment in the stock market. Well, if you believe that that's true, tell that to people who wanted to retire between 2008 and 2018. People that wanted to retire, and many people in general, lost 40, 50%, sometimes even more of their entire retirement savings. So we can't always guarantee that even though over 90 years in the stock market, it returned 9%, if you say that that is true, are you going to retire in 90 years? Most of us probably don't plan on working 90 more years before we retire. So that's going to be different for you. How long do you have for retirement? Do you have time for the market to recover and make a gain just so you break even from where you are today? Is it give you and your spouse more peace of mind of knowing that you have that available liquid cash? Now, let's say, for example, you built that money up in your infinite banking policy, but didn't pay off the mortgage. Now, if you're not familiar with this concept, click the link in the description below. There's a webinar that goes over more details on how and when to pay off your mortgage and if that's a good idea for you. So here's the big idea I want you to take away after watching this video. There's obviously a lot of reasons and benefits why somebody should pay off their home, as well as why they should have liquid capital and not pay off their mortgage early by paying it to the bank. But most of the reasons we cover today are more compelling if you don't have a banking policy. This is what usually comes up in conversation when you're planning, or we are planning together to put your banking policy together. Generally speaking, from my experience and from my viewpoint and from clients that I've talked with, as well as other agents in the industry, they found that it's much more beneficial for them or their clients to let the money continue to grow cash value in their own banking system rather than pay the mortgage off. With that being said, remember this. People don't buy what's in their best interest, in what they need. People buy what they want. And if what they want is to feel empowered by being able to pay off their mortgage, especially if you're married and you and your spouse have differing opinions, this is something that you're going to have to come to a compromise, or what you feel is in each other's best interest. So if you'd like a free consultation along with a written game plan with no obligation, click the link in the description below to watch our webinar. It'll go through more information on how this can benefit you, your business, or your family, and I'll be able to schedule a time to go over your specific needs. And don't forget to like, subscribe, share this with other people that might find value, and don't forget to hit the bell so you'll be reminded whenever I upload new videos every week. God bless and have a great day.